Hello, and welcome to Navigating Seasonal Cycles with Jake Bernstein. The information provided in this episode is for educational purposes only. There is a risk of loss in all trading and investing. The results shown are hypothetical and should not be construed as investment advice. And now, over to you, Jake.
Greetings, everyone. Jake Bernstein here on Tuesday, the 12th of November. I want to thank everyone at the Foundation, especially Dan and Bill, for helping put this together. And thank you all for the great emails that I received, as well as the great questions. Because this is not all about answers. You can't get good answers if you don't get good questions, and I've gotten some really good ones. We've been talking about seasonal cycles. The good news about seasonal cycles is there are many of them. The bad news is there are too many of them, and you have to choose. In order to choose and make intelligent decisions, we need intelligent questions. Many of you are familiar with the standard cyclical behavior of markets. So, for example, when I switch slides, go to the next slide, we'll see a typical cycle. This is my work. These are some of the cycles that I look at. The good news about cycles is they exist. They're available in every market. The bad news is we have too many choices to make. Here, for example, is the cycle in the Bitcoin, covering an extensive period of time all the way back to 2019. And you can see that in most cases, these cycles are reasonably symmetrical. They top somewhere in the middle. Sometimes they're skewed a little to the right, skewed a little to the left, but most of the time they're cooperative. So if this was a chart we were looking at back in early 2024, we expected it to come down and bottom sometime in late 2024. Well, certainly that's the process that's in effect right now. You see the Bitcoin making new all-time highs and due to come down from these levels to make lows in late 2024. So what we expect now in terms of the pattern is new all-time highs, which was predicted many, many months ago, and then decline from these very high levels. We'll see how that happens. But the good news, like I said, is many times these cycles are symmetrical. The bad news is that when they're not, we don't know what to do. I've taken care of some of that problem by using setup, trigger, and follow-through. In other words, in the big grand scheme of things, the cycle is merely a setup. It represents only step number one. But if we're waiting for a cycle to be completely accurate, that is not going to happen most of the time, and we'll be very disappointed in our work. So we need either to do two things. Number one, we need to zoom in and look at finer detail. For example, this, which is more recent, and we're asking the question, how did this turn out? So everything looks very nice over here, symmetrical, reasonably symmetrical over here, very symmetrical over here, but here it's skewed and tops out late and bottoms early. This is where we are right now. This is a current chart right now. So, wait a minute, this may be, hold on one second, just let me look at one thing here. Yes, this is the current chart. So what happens? As you can see, testing all-time highs and due to come back down again until March of 2025. It's beautiful cyclical work. We love it when it's very symmetrical because that's what this is. Cyclical analysts praise for is the symmetrical cycle. But what if there was a cycle that was so symmetrical that you won't believe what it does? Example, if I said to you, there are some cycles that are 365 days long, sometimes 364, sometimes 367, but very, very nicely within that window, and from one point to the next, they establish a pattern. So as an example, seasonal work based on pre-holiday behavior is one of those cycles. Now, some people would argue with me. They'd say, it's not a cycle, it's a methodology. Well, I say that if you have a span of time from point A to point B that's the same or close to the same every year, that's a cyclical, repetitive pattern. Let me show you what I mean and expand on this little, very interesting topic. In the 1950s, a trader by the name of Art Merrill, you may have seen me talk about this word before. In the 1950s, a man by the name of Art Merrill, an avid stock trader, discovered a pattern in the Dow Jones, which he called pre-holiday behavior. He studied the Dow Jones average all the way back to the 1800s and discovered a very interesting repetitive phenomena, which he called pre-holiday behavior, which I call a seasonal cycle. He discovered that on the day before major U.S. legal holidays, the Dow Jones Industrials was primed to go up. In other words, let's take a holiday that's coming up shortly. Thanksgiving in the United States, not to be confused with Thanksgiving in Canada. Thanksgiving in the United States always happens on a Thursday, the last Thursday of November. The pattern is very clear and has been established clearly and statistically going all the way back to the 1800s. If you're a short-term trader, this is a godsend to you because it allows you to make money on a high probability trade, and you can increase your position size to compensate for the size of the move. So you have two choices as a trader. Choice number one, make big money on the low probability, low significance move, in other words, not too frequent, or make small money on a very repetitive, high probability trade that occurs very infrequently. In other words, trade a small position for a big move if you multiply the size of the position, or trade a big position for a small move, or the other way around. Let me be perfectly clear. Example. We know that the seasonal moves, by their very nature, pre-holiday, are small profits. Why? Because they're limited in time. So, for example, the holiday trade on Thanksgiving. Thanksgiving is always on a Thursday, as I said. Therefore, your buy would be on Tuesday, your exit would be Wednesday, and there's no trading on Thursday, which is Thanksgiving. With the electronic markets open, in many cases 24/7, there may be a partial day on Thursday, Thanksgiving, but we're not trading that day, we're eating turkey. Therefore, the rule that Merrill established was very simple and completely mechanical. Buy on the close of trading Tuesday, get out on the close of trading Wednesday. It couldn't be more simple. We'd use a market on close, MOC order. If you're concerned about stop loss, that's not a problem because you can do this trade in a one-day option. The maximum you can lose is the premium of the option. Otherwise, you can make some pretty good money in a very quick turnaround, and you can compensate for the size of the loss or the size of the profit by the size of your position. I'm going to show you momentarily what happened this year, because so far, all of the major holiday trades have been correct and profitable this year. I'll show you a little calendar momentarily. This book, The Behavior of Prices on Wall Street, is a fascinating book because it not only talks about pre-holiday seasonals, but it also talks about other aspects of patterns in the Dow Jones that go back many years. What's particularly interesting about this work is it's there for the longer term. This is not the kind of work that goes back 5 years and finds 6 examples and says, well, we've got 6 out of 6. It's a beautiful methodology. No, this goes back over 100 years, 120 years in some cases, to give you statistical probability that is very unlikely to repeat unless it's a factual situation. In other words, this is not a pattern that's a theory, it's a pattern that's a fact. And you're much better off as a trader dealing with facts than you are dealing with patterns that are not facts. Now, many of you may have been spoiled by the work of some of the beautiful psychoanalysis programs. You can take 10 or 15 different cycles and combine them into one pattern that predicts what the market's going to do. While I have the utmost of respect for these patterns, that's not the kind of trader that I am, because I believe there's enough random behavior between cycles to account for very, very simple moves that are not predictable. So I would rather go from point A to point B in 1 or 2 days to make a high probability profit and compensate for the size of that position in order to make more profit. Example, would I rather trade a 70% move that makes $12 or a 90% move that makes $3 or a 50% move that makes $27? Think it through for a moment. Don't let the profitability attract you. Trade on the basis of percentage of probability. So I'm going to show you that momentarily. Let me go to the next slide. So here's a calendar of the 2024 holidays in the United States. I'm showing every major holiday with the exact date and the name of the holiday. So we've got New Year's Day, we've got the birthday of Martin Luther King. We have excluded that from our trading for one simple reason. It has nothing to do, although some people may react and say, why not Martin Luther King? The answer is real simple. There is insufficient data because Martin Luther King has not been alive for 120 years. We look for as much data as we possibly can. Certainly, we can study it and see if there's an effect there, but the statistical probability would be low no matter how well the pattern has worked in the past because the size of the database is limited. Compare that to Memorial Day, which has about 100 years of data. That's the issue. Now, the same problem would hold true with Juneteenth. There's insufficient history. I'm sorry, but that's just the way it is. Compare that to Independence Day, July the 4th, or Labor Day, or Columbus Day, or Veterans Day. Now, Columbus Day is no longer Columbus Day, it's Indigenous Peoples Day, but even though the name has changed, the history is still there. So to my knowledge, since I've been active in every one of these trades, every single one, even up to Columbus Day and Veterans Day yesterday, has been profitable to varying degrees this year. I'm going to show you how it turned out. So in other words, the Veterans Day trade, which was yesterday, 11th. The market was open on the 11th, but that doesn't mean we traded. The trade here was to buy on the close of trading Thursday, get out on the close of trading Friday. So Monday, we didn't have a trade. Some people might say, well, wait a minute. Look at how big we opened to the upside on Monday. The answer is no problem. We're not going for the size of the move. We're going for the size, the probability. That's the most important thing. There are ways to have gotten this other trade, but we'll talk about those in another session. That has nothing to do with this particular cycle. The most important thing for you as a trader is focus, 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 and that's what we're going to do. So let's focus. Let's take a look. We're going to go to the next slide. And here's the slide. This is a chart of YM1 mini-sized Dow futures showing what happened. This was this green line represents the 12th, the 11th. This over here is the 12th today. So if this was the 11th, Monday, then the trade would be to buy the close of trading Thursday, which is right over here, get out on the close of trading Friday, which is right over there. It couldn't be easier. One of those monkeys that escaped from the lab in New Jersey, wherever that was, could probably do this trade very easily. Buy on the close of trading Thursday, get out on the close of trading Friday. It's right over here. That procedure, completely mechanical, was effective, not involve too much thinking. You didn't look at the geopolitical situation. You did not consider the war in the Middle East, the war in Iran and Russia and Ukraine. None of that took into consideration. We didn't take into consideration the existing trend. None of that stuff. This is very simple and mechanical. And the best of all, we knew exactly what to do in the meantime. Market on close, buy right over here. Market on close, sell right over here. If you wanted to have a profit target, we've done some research on that too. The range of the Thursday right over here, the range, the high to the low, would be your first profit target. So if you bought it here, you added the range from there, you get up somewhere about over here, that would be your first target. You could then put in a stop and just let it go. If you wanted to go for a higher profit, that would be very easy to do as well. Just keep the trade, place a trailing stop, break even, and let it go, or use an intraday 3-period moving average up the low stop. That's all there is to it. Now, don't get distracted. Don't look at this chart and say, but Jake, look at what we missed. We missed this gigantic opening. Remember, it's not about what we missed, it's about what we got. So I would rather have a high probability of a move, even if the move is small, than a low probability of a very large move, as I explained before. So, if you think about it, in futures, many-sized futures, A $1,200 move literally overnight is not a small move. It's a big move. And remember, this is easily done with options. All you had to do is buy a call option on the close of trading Thursday, get out of the call option on the close of trading Friday, and you're done with it. That's all there is to it. Now, what about this? Let me address this issue right over here. You're concerned because you missed this profit over here. No problem. We're not a one-horse pony. We do other tricks as well. So we have other methodologies which are not cyclically based. They're based on patterns, but not this particular pattern that we're talking about today. As I said, it's all about focus. Let's talk about focus. Let's go back to this. What if we went to Seasonal Trader and we said, look, is it possible that this move over here, the pre-holiday move for Thanksgiving or Labor Day or whatever it is it possible that it begins earlier? We could do some research. As an example, let me show you. And I call that spread of cyclical effect. In other words, the move is supposed to begin at point A, but it actually begins a week earlier, 2 weeks earlier. Is it possible to extract more profit from this pattern than just that one particular day? Yes, we can. We can go, for example, to the S&P 500 and do a search. I'm going to show you something. We know that July the 4th is a pre-holiday seasonal. So whatever day July 4th is, we get into the market on the close of trading 2 days before that, get out the next day, and the trade is over. But the question I'm asking is, during that cyclical period of time, from the last year to this year, is it possible that this July move begins sooner? How do we find out? We use a research tool. Very simple, we say, for S&P futures, for the month of June and July, are there any trades that have been right 70% of the time or more with a stop loss and a duration of 25 days or less? Obviously, garbage in, garbage out. If this is garbage to the computer, we'll get garbage out. But if the computer understands what we're looking for, and if that particular pattern is there, we have the possibility of finding it. If the computer can't find it, it's not there. But if it can find it, it's a real thing. It's not a numbers crunch or a black box. We know the process. It's an iterative process. It goes through every day and asks the question, is it predictable from this day forward to this day in the future? Is it predictable for the next 6 days, 10 days? In this case, we've chosen 25 days. We're asking the question, is there a predictable pattern in the S&P during June to July with 70% accuracy or more? Computer searches trillions of data points and finds this. It finds this pattern and says, there is a pattern from July the 10th through July the 15th, a very brief pattern, 5 days with 81% probability. But if you're looking for a bigger move, the average move over here is 24 points. The average move here is 63 points. Clearly, I want to go with the 63 points, even though I'm sacrificing a little bit of accuracy. So I can compensate. For this 5-day trade with high probability, I can trade a bigger position, or I can defer. I'm willing to give up some percentage accuracy to take a trade with a bigger profit that lasts a little bit longer. But either one of these would be effective and accurate. And they would demonstrate clearly the persistence of the market's ability to have spread of effect. In other words, to start going up before the July seasonal date. This is what that trade looks like on the computer. 26 years of history back to the start of trading in S&P futures with this performance. Now, let me tell you about a rookie mistake that you should not make if you're interested in this methodology. And by the way, I encourage you not to believe what I'm telling you. I encourage you to find it on your own, because only by finding it on your own will you believe that it actually exists. And only finding it by your own will you be able to say, yes, there's a cyclical pattern here, there's something going on that I should know about. You look at this chart and you will say, and my job is not only to show you the cyclical nature of the markets seasonally, but also to show you where most people make mistakes. Because remember, the weakest part of any methodology, whether it's research or actual trading, of course, is the human being, which tends to gum up things all the time. The average person is going to look at this chart and they're going to say, wait a minute, Jake. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. 13 or 14 years this trade has made money. If everybody knows that it's not going to work anymore, that's not true, because look, this is a very common trade. It's not a great big state secret. Even after all of these years of tracking this trade and publishing it in many of my books, this trade goes on to show its largest single year profit ever. Does that mean that everybody knows about the trade? Look, the bottom line is this. Everybody knows that at some point, for example, some idiot somewhere was going to set off a nuclear device. It might be a low grade, it might be something tactical, but it's going to happen. We know it's going to happen. Does that mean that it's not going to happen because everybody knows it? No, it's just that simply most people don't want to admit to it. So the bottom line is this. When you look at a chart, when you look at some statistics, don't ask the question whether it's going to happen because of this or that. Ask the question, can you afford the risk? Can you mitigate the risk? Did the trade trigger? Did the trade not trigger? Does it have a realistic profit objective? Those are the metrics you should be looking at. How can you participate in this trade without risking the farm? That's what you should be looking at. So, what happens? Let me show you something else. If we want to see what that chart looks like visually, you can put it on the screen and ask the question, is this the period in study? Example, we're looking at June 28th through July 22nd. Looking at the chart, June 28th through July 22nd covers this expansive time right over here. And it shows the plot as being up. So this validates or verifies, or is another check and balance against what you were going to do. Some people are visual. If they can see it, they can appreciate it better. So, let me show you what's coming up. By the way, we can search other indexes. So, for example, this chart that I just showed you before was the S&P. Here is the Dow Jones, back to 1920. Same pattern, back to 1920. Now, I ask you a question. Who in this business goes back over 100 years to search for pattern? I do, and I strongly suggest you do as well. Otherwise, you're going to make decisions based on a limited data set. So, for example, reverting to a statement I made before, we don't have Martin Luther King's birthday over the last 100 years. We don't have the data. That's what's important, is the data. It's all about the numbers. So looking at the data, very simple. Going all the way back to the 1920s, and I ask you again, who in this business goes back that far? I do, because I believe the more data you have, the more confident you will be in what you're doing. Going back all that period of time, the statistics speak for themselves. 77.9% of the trades have been correct. Very impressive and very statistically significant. Now, if you're a trader looking for a good pattern, a repetitive pattern with high probability on which to base your work, guess what? You just found it. All you have to do is wonder how you're going to mess it up, because you're going to be the weakest link in the chain. I want to show you something else that you might find interesting as well as profitable. And one more thing. I'm not guaranteeing profits. I'm not giving you recommendations. I'm simply showing you the fate and the force of history. If you understand history, you will be very, very much on the side of the winning trader as opposed to the losing trader. So we have here the results of that search. Searching the Dow Jones all the way back to 1920, which is over 100 years, and we come up with the results, which are very similar to the pattern that's been established over the last 13 years. Buying on the close of trading the Dow Jones, June 27th, getting out on the close of trading July the 15th, with all of these associated statistics, very impressive. And here is what it looks like on a graph. So, you will observe that the market has gone literally parabolic, which will be a very interesting interpretation for the new trader who's going to say, It can't possibly be true. It can't continue. Look at what's happening in Ukraine. Look at what's happening in the Middle East. The war's going to stop it. We've got divided House of Congress. We've got a president who's intent on starting a war. Whatever the excuses would be. Then you look at it and you say, you don't want to make this trade because it's had some losses. 1, 2, 3, 4, 5, 6, 7, 8, whatever it is. Well, there's a way to stop that. The way to stop that is to trade an option instead. So you have many different alternatives, but the facts are what they are and they can't be changed. So let's take a look at something else. How about the Thanksgiving trade? By the way, this is the history of the trade I just showed you. And let me repeat what I've said many times before. In terms of the year, in terms of the calendar, this is where we are right now. The first 2 weeks of November, we're already beginning the classic seasonal up move, which I've spoken about in previous sessions here, telling you that the end of the year is usually strong. And by the way, statistically, if you end up strong in October, which we did so far this year, that tends to predict even higher probability for up moves in the months of November and December. Remember, I'm not telling you what's right for you. I'm not giving you a recommendation. I'm simply studying the course of history, which is, after all, what this is all about. So let me review something for you before we run out of time. So here we go. Let me show you this. Here are the Thanksgiving Day holidays. So I predict that Thanksgiving fare will be puree of bear, meaning this. This is not the time of the year to be bearish, and especially prior to the Thanksgiving Day holiday. These were the rules for last year. They can easily be changed to this year. The average winning of 71%, which is a 1 out of a 10,000 chance occurrence. The rule is very simple. Buy on the close of trading the day before the holiday. So let's review that. Last year, Thanksgiving was the 23rd of November, the last Thursday of the month. You bought on the close of trading Tuesday, got out on the close of trading Wednesday. Very, very simple. You can do it in the S&P, the YM futures, the diamonds, the spider, the Russell 2000, or the OEX option. If you want to define your risk more clearly, you can use a high delta option, or close to the money, or a one-day option. You can keep part of the position for maximizing with break-even or 3 MA low stop. All of these apply. Very simple, very strategic, and very accurate in terms of probabilities. This is what the calendar looked like last year. Last year was November the 23rd, 2023. That was a Thursday. You bought on the close of trading the 21st, got out on the close of trading the 22nd. It couldn't be easier. So think about it, research it, and do it yourself until you believe it. Go back as many years as you want to. Certainly with all the data we have now and the speed with AI that works with AI, you can research this on your own very easily. In fact, you can generate even more metrics than I've given you here, so you do a little work on your own. Let me show you one more thing. Just one moment, please. I'm going to go back a little bit. Here we go. So this would be, a moment, please. If you wanted to use a timing trigger, use 2 moving averages. The green line is an 8-period simple moving average of the high, of the close. The red line is an 8-period simple moving average of the open. So when you have this configuration, the moving average of the close is greater than the moving average of the open. The correlation to an up market is very, very high. When the 3-period moving average of the low of the close is below the 3-period moving average of the open, it signifies a bearish trend. I will teach that timing in future sessions, but I want to go back to this right again. If you can afford to buy, or if you can afford to study this book by Art Merrill, The Behavior of Prices on Wall Street, is well worth reading and keeping in your library. There's one more thing I want to show you before we run out of time. This is the book. You can find it on the internet for about $100. I want to show you one more thing. Let me go forward a little bit. We have several more holidays coming. So Thanksgiving trade coming right up on the 28th of November. Then we have the December 25th trade, which is Christmas Day. And again, Christmas Day this year is going to be on a Wednesday. So you would make the trade on the close of trading Monday. get out on the close of trading Tuesday. It's that simple. I encourage you to write me if you have questions. If I have not answered your questions, I try to be as clear as I can. Even with my old man's voice, I try to be as clear as I can. So remember, seasonal behavior is cyclical. Seasonality is part of the bigger cycle. I happen to believe that for most traders, seasonality is a very effective methodology because many traders don't have the ability to hold on for a long enough period of time to make money. And let me say one more thing. You cannot predict everything. Therefore, if you're trying to combine 7 or 9 or 10 different cycles into one prediction, for my money, I'm concerned because some things cannot be predicted, even though they may be cyclical. Sometimes they fall out of the rhythm and it's difficult to make money. My approach is more pragmatic. I like things that work, even though the probability is high, the move may be small. As I said before, I prefer a high probability to anything else because I can compensate for the size of the move by the size of the position. Thank you, folks. Let me hear from you if there's things that you'd like to hear about in terms of seasonality. I have other tricks in my bag. Thank you very much, Dan and the foundation. Thank you very much, Bill. Appreciate it, and we'll see you all next week.